Here is a commercial real estate truth many investors are not ready to hear. The property type that delivered some of the strongest returns between 2010 and 2022 may actually be one of the riskiest choices heading into 2026. And if you're buying today just because something performed well in the past, the next slowdown could hurt more than you expect, because the conditions that fueled those gains have shifted. Interest rates are staying elevated longer, lenders are more careful, tenant priorities are changing, but here's the interesting part. By the end of this video, you'll see clearly which commercial property type tends to hold up better during downturns, refinances with less stress, and bounces back quicker when the economy recovers, and the answer isn't what most people assume. Commercial real estate moves in cycles. During good times, almost every type of property can look safe and profitable. Because borrowing is cheap, rents usually rise and refinancing feels easy, so everything appears solid. But when rates stay higher for longer and banks tighten standards, the market starts to sort the durable assets from the fragile ones. And at that point, the question changes. It stops being about who made the most money during the boom, and it becomes much simpler. Which property keeps collecting rent reliably even when the economy slows? Because in commercial real estate, true safety isn't about being popular or flashy, it's about how well the income holds up under pressure. And this is exactly where many investors go wrong. They chase what looked best last cycle, they follow headlines, they buy momentum, but they miss the one factor that really decides who survives the next rough patch. And that factor is tenant necessity. Here's the straightforward reality. The building itself doesn't make a property safe. What makes it safe is how essential the service or space inside is to people's daily lives. Because when money gets tight, people cut back fast on things they can live without. Vacations slow, luxury shopping drops, business travel gets canceled, companies shrink their offices or pause expansion, but some needs don't disappear. People still buy groceries, fill prescriptions, go to the doctor, and most importantly, they still need a place to live. So the line between optional and non-optional spending often decides whether rent checks keep arriving on time. And that difference explains why some property types weather storms better than others. But here's something many people overlook. A property that feels rock solid during strong growth can quickly become vulnerable when credit dries up and demand softens. So let's walk through the major types one by one, starting with the ones facing more headwinds in 2026. Office properties were once viewed as very stable. They had long leases with big companies, predictable cash flow, and institutions loved them. But the way people work has permanently changed. Remote and hybrid models are now standard for many organizations. Companies are downsizing footprints, consolidating locations, or in some cases eliminating offices completely. On top of that, a huge wave of office loans from the low-rate era is maturing now. Those buildings were financed cheaply between 2018 and 2021, but refinancing today means much higher payments. Imagine an investor who bought a nice suburban office in 2019, solid tenants, long leases, low interest, everything looked perfect. Then rates rose. A few tenants downsized. Vacancy ticked up, and suddenly the debt service became a strain, even though the building hadn't changed. So while trophy offices in prime city centers can still perform, the sector overall carries more uncertainty heading into the next cycle, especially for older or secondary properties. Retail is more nuanced. Not every shopping center behaves the same. Properties anchored by grocery stores, pharmacies, or discount retailers usually stay fairly steady because people need those essentials every week, even when budgets tighten. But discretionary retail feels the pain quickly. Luxury boutiques, electronics shops, fashion outlets, and lifestyle malls see traffic drop fast when consumers cut non-essentials. So retail can be defensive when it's tied to daily necessities and located in strong neighborhoods, but stability really depends on the tenant mix and whether the center serves true everyday needs. In 2026, necessity-based retail is holding up better than many expect, while fashion and entertainment-heavy centers face more pressure. Hotels are a completely different animal. Unlike most commercial assets, their revenue resets every night. Rates flex with demand, which gives flexibility in good times, but creates big swings in bad times. When the economy slows, business travel drops sharply, leisure trips get postponed or downgraded, occupancy can fall quickly. Yet staff wages, utilities, and maintenance costs don't shrink much, so hotels can deliver excellent returns during expansions. But historically, they rank among the most sensitive to recessions because discretionary travel is one of the first things people and companies cut. Industrial properties have been stars for the past decade. E-commerce growth drove massive demand for warehouses, distribution centers, and fulfillment buildings. Rents rose, vacancies stayed low, investors poured in, but that success also pushed prices higher and cap rates lower. So many assets were bought at peak valuations. Today, demand remains solid thanks to online shopping, supply chain needs, and some manufacturing reshoring. But the sector is cooling from its pandemic highs. Leasing is softer in some markets, and future returns will depend heavily on buying at reasonable prices rather than chasing momentum. Still, industrial tends to be more resilient than office or hotels because it's tied to goods movement which doesn't vanish in a slowdown. So let's pause for a quick mental checkpoint. Imagine you own three properties: a high-end fashion retail store, a corporate office building leased to a tech firm, and a workforce apartment complex full of teachers, nurses, and service workers. If a slowdown hits tomorrow and lasts a couple years, which tenant is most likely to keep paying rent without major issues? Hold that thought, because the answer reveals a lot about where safety really lives in commercial real estate. The answer is almost always the workforce apartments. Because housing is a fundamental human need, people don't stop needing shelter even when times are tough. Luxury high-rises can see more turnover because tenants are price-sensitive and can move down market. But workforce housing, think Class B or Class C communities with practical rents, good locations near jobs, serving teachers, nurses, technicians, police officers, retail managers, tends to stay occupied. And interestingly, during slowdowns, some people actually move from expensive Class A apartments into more affordable ones, which can boost demand for the middle and lower end of the market. So in 2026, workforce multifamily stands out as the most durable, with more consistent occupancy, easier refinancing because lenders like the steady cash flow, and faster recovery once conditions improve. Let's make this visual so it sticks. Picture the economy as three layers. The top layer is optional spending, hotels, luxury retail, entertainment. That layer empties fast when wallets tighten. The middle layer is business expansion, offices, some industrial space tied to growth that shrinks when companies pause hiring or delay moves. But the bottom layer is human necessity: food, healthcare, and housing. That layer almost never empties completely. People may downsize, share space, or relocate, but they still pay for a roof. And because of that structural demand, workforce multifamily properties tend to show steadier rent collection, lower vacancy swings, and better resilience when refinancing or selling. It's not the sexiest asset. It's not the one that triples in value during a boom, but it's the one that keeps producing income while other sectors wait for better days. Now, before you think just buy any apartment building and you're safe, let's be very clear. Even the strongest property type can become risky if you overpay, use too much debt, or pick the wrong location. Safety in commercial real estate always comes back to discipline. Buy below or at replacement cost when you can. Keep leverage conservative so higher rates don't crush you. Lock in fixed-rate financing or hedge properly. Choose markets with steady job growth and population increases. Underwrite rent growth conservatively instead of hoping for big jumps, because at its heart, commercial real estate is a business, not a speculation, and the safest path is focusing on cash flow you can count on year after year. So if you're building long-term wealth in commercial real estate heading into 2026 and beyond, the practical strategy is surprisingly straightforward. Prioritize assets tied to essential needs, especially workforce housing in solid employment markets. Focus on reliable cash flow rather than hoping for huge appreciation. Avoid heavy leverage that can force sales at bad times, and always underwrite like the next slowdown could start next month, because the safest property in commercial real estate is rarely the shiniest tower or the trendiest retail strip. It's usually the quiet apartment community where rent checks arrive every month no matter what the headlines say. And once you start evaluating properties through that lens of necessity and durability, you begin seeing opportunities most investors miss while they're chasing the last cycle's winner.